Hello and thank you for joining me for the next Bell Direct reporting season video this August reporting season FY25. I'm Grady Wolf, Senior Market Analyst with Bell Direct. So far this reporting season we have seen 21 companies that release results with 6 beating expectations, 10 meeting expectations and 5 missing expectations. 6 companies have been upgraded by brokers while 4 have been downgraded, signalling a low base was expected across the board for FY25 results so far, with more surprising to the upside. Investors have been very reactive with significant share price movements into the double digits on the day results have been released, both to the up and downside. So let's dive into the results that have stood out in the market this week and any new themes that are emerging heading into FY26. Despite reporting on a March year end, investors were impressed with global leading geolocation services and tech provider Life360 ASX 360 yesterday with its Q2 and H1 results released. Life360 delivered another record-breaking quarter in Q2 25, marked by strong growth across users, revenue and profitability, as well as key leadership changes with co-founder Chris Hulls stepping up as executive chairman and Lauren Antonoff appointed as new CEO. The platform added 4.2 million monthly active users, MAUs, bringing the monthly active total to 88 million, while paying circles grew 25% year on year to 2.5 million in total, including a 28% increase internationally with notable traction in Australia. Families are increasingly treating Life360 as a household essential, on par with Wi-Fi or insurance, especially among the anxiety generation, who view the app as a non-negotiable tool for safety and peace of mind now. Revenue for the quarter for Life360 rose 36% year on year to $115.4 million US, driven by a 35% increase in subscription revenue, while net income reached $7 million US, reversing a $10.96 million loss from the prior year. Adjusted EBITDA grew 85% to $20.3 million US, and operating cash flow rose 303% to $13.3 million US, marking the 9th straight quarter of positive cash flow and the 11th for EBITDA. With $434.2 million US in cash on hand, the company raised full-year guidance across all major metrics, including total revenue with the new guidance range of $462 to $482 million US, subscription revenue with the new guidance range of $363 to $367 million, hardware revenue new guidance range of $42 to $50 million, and adjusted EBITDA new guidance range of $72 to $82 million. New offerings such as a pet tracker, real-time weather alerts through AccuWeather integration, and a gifting campaign with Nift further enhance the platform's value, reinforcing Life360's position as a core digital utility in modern family life. Amidst a declining consumer spend environment in the discretionary space, Scali ASX NCK defied the odds as consumers spent big at the homeware retailer throughout FY25. While the results were mixed on a beat and miss front, the underlying strength of the business shone through to boost investor sentiment ahead of the new financial year. The highlights of FY25 for Scali included group revenue up 5.8% to $495.3 million. Gross margin fell 200 basis points to 63.5%, but this beat expectations. Underlying NPAT fell 24.4%, and the total dividend from the group fell 11.8% to 60 cents per share, but this still beat consensus expectations, so the bar was set pretty low. The company reported a 7.7% year-on-year increase in Australia and New Zealand sales orders for July. Losses in the UK are expected to persist until store refurbishments and sales improvements are complete. A strength of the company was its resilient gross margins towards the back end of the second half of FY25, which provides investors with some confidence heading into FY26 that such margins can be maintained. JB Hi-Fi ASX JBH posted a strong result for FY25, but investors' focus shifted to the leadership uncertainty following the surprise announcement that CEO Terry Smart will step down on October the 3rd. Current COO Nick Wells will take over though, but with lack of clear reason around the transition that weighed on sentiment quite heavily on the day the results were released. Operationally, JBH outperformed in a soft retail environment though for FY25. Group sales rose 10% year on year to $10.56 billion. EBIT lifted 7.3% to $694.1 million, and NPAT increased 5.4% to $462.4 million. The company raised its final dividend by 5.4% to 275 cents per share and declared a 100 cents per share special dividend. From FY26, the dividend payout ratio was a notable highlight of the results, with it increasing from FY26 from 65% to now 70 to 80% of NPAT. So good reward for investors there. There were a few weak spots though. The good guys saw higher operating costs and margin pressure, while group inventory jumped 18.7% year on year to support new store openings in late FY25 and early FY26. Investors will be watching how this is managed in the upcoming half, as inventory is a key metric to look at when looking at investors and on the retail space. The newly acquired E&S business performed solidly, with FY25 sales up 5.2% and margins in line, but FY26 sales are down 2.7% so far already this new financial year, potentially signalling some softness in the premium home appliance segment. Despite the leadership change, JBH remains in a strong position. FY26 has started well, with Australian sales up 6.1% year to date and July comps up 5.1% year on year, reaffirming the brand's resilience and relevance. So with all those results in mind, and CBA among other big names releasing results this week, what themes are we seeing? First of all, FY26 guidance is vital to securing investor support, and guidance upgrades, even if from a conservative base, have been rewarded by investors, so that's something to keep in mind. Increased CapEx and R&D spending is hurting margins, and it's being punished by investors, especially when the spend is not incorporative of AI expansion. Tariff implications are being punished, like with this reporting season, like for Light & Wonder issuing disappointing guidance attributed to tariff issues. And consumer spend in discretionary space during FY25 was pretty limited to tech and homeware, as the cost of living pressures finally hit after the high interest rate environment we lived in for a few years. Thanks for joining me for this video on our reporting season coverage. Stay tuned for the fourth video out this Friday. I hope you have a wonderful Wednesday, and as always, happy investing.